It's a continuation of previous slide, operations. In this slide is also we are going to see three items in operations or understanding the concepts of mutual fund. Valuation gains. It is very important that every company's investment should be valued. So in mutual fund is also every scheme has to be valued by the investor or outside company holders. Investing companies are those who are interested to invest in the company in the scheme in the future. How the valuation is going to be quoted means investment owned by the scheme may be quoted in the market at higher than the cost paid. So what I am going to pay for that particular unit at the time of purchase, uh, at that same which is going to be calculated at today rate, it is called there the market rate. So when the scheme is calculated under this particular phenomena, then it is called there the valuation. If the return is more or the value is more, then it is called valuation gains or unrealized gains. When the value is less, then it is called there the valuation losses or unrealized losses. uh, we'll move on to the next one, market to market, which is very important concepts in the mutual fund industry. The practice of marking securities to their market value is called market to market valuation. The true worth of the each unit of every scheme, that is called NAV, net asset value, is calculated based on market to market valuation of the investment portfolio. Uh, it captures all the gain and losses realized and unrealized besides the interest and dividend income earned. It is mandatorily every day this rate has to be calculated by the industry, by the company and scheme. This is the reason why the NAV of the particular scheme is fluctuating between the 2 points. It is mandatory that company has to be invest, and from the view of the investor, whether I am going to get a profit or good return or well capital gains means it is based on how much rate I am paying for that particular units at the time of purchase. It will give a return by means of return income is more or the giving the capital gains. And move on to the third one, scheme running expenses. It is always every scheme has its own cost by means of running expenses. What is mean by scheme own cost mean? Cost is incurred for the purchase right from the inception of the scheme and till end is going to be invested and it will be monitoring and so on. So company and the scheme owner is having own in expenses. That expenses naturally will be, it cannot be avoided, but it not in the manipulated way. So it is very important the company has to look forward there the expenses spended for that particular scheme. And moreover, SEBI have there the concern over the return earned from the mutual fund to their own investor. Already the mutual fund is not a riskless industry. Because of the reason at the time when we are giving the more cost spending for the running of the particular scheme means naturally it will affect the profit as well as the return and NAV of the particular scheme. So SEBI restricted to certain level with the depend upon the scheme is introduced by the other mutual fund companies. Because this reason why the mutual fund is so cheapest investment avenue of the investors. In this slide, we had a discussion regarding about valuation gains and then market to market and scheme running expenses. Certain items will improve as the profit of the scheme. Certain things will make the loss to the scheme. The items which will help to improvise the profit of the scheme are interest income, dividend income, realized capital gains, and valuation gains. And the items which will reduce the profit of the institution or it increase the losses means realized capital losses, valuation losses, scheme running expenses. And it's most important, this all it make a destiny of their that particular schemes NAV. If at all doing good, it will give their the good NAV. If it is not performing well, then NAV will goes down. Nandri.